Have you ever wondered why Bitcoin went from being worthless internet money to a trillion-dollar asset that's shaking the foundations of global finance? Most people believe it was just luck, a wild gamble that somehow paid off. But the truth is, Bitcoin's rise wasn't an accident. It was carefully engineered from day one, built on technology, economics, and game theory that make it unstoppable. Today, we're going to break down why Bitcoin's success was inevitable and why it continues to grow stronger every year. The birth of Bitcoin, a problem looking for a solution. In 2008, the world was reeling from the global financial crisis. Banks had collapsed, governments were bailing out billion-dollar corporations, and people lost faith in the financial system. This was the perfect storm for Bitcoin's arrival. Satoshi Nakamoto, Bitcoin's mysterious creator, didn't just create another payment method. He engineered a solution to decades of financial instability, a decentralized currency outside the control of banks and governments. Bitcoin's rise wasn't luck. It was designed to appear at the exact moment when trust in traditional finance was broken. The timing was no coincidence. The white paper, Engineering Trust. On October 31, 2008, Satoshi published the now famous Bitcoin white paper. In just 9 pages, he outlined a vision of a peer-to-peer cash system powered by blockchain technology. But here's the key: Satoshi wasn't pitching an idea. He had already built the system. Unlike other inventions that take years to prove, Bitcoin launched ready to go. That was by design. The technology was engineered to solve the double spending problem, which had killed every previous attempt at digital money. By making transactions irreversible and transparent on a blockchain, Bitcoin made fraud mathematically impossible without massive computing power. This wasn't luck. It was deliberate engineering of trust through code. Decentralization, the masterstroke. Bitcoin isn't controlled by a CEO, a company, or a government. It's controlled by the network itself. That decentralization was no accident. It was engineered to make Bitcoin immune from censorship or shutdown. Every node in the Bitcoin network keeps a copy of the blockchain. Even if governments tried to ban it, the system keeps running because no single authority controls it. Satoshi built Bitcoin like a digital hydra. Cut off one head, and 10 more appear. This decentralized design wasn't random. It was the core of Bitcoin's survival strategy, ensuring its growth no matter what. Digital scarcity, the 21 million supply cap. Why does Bitcoin keep rising in value? The answer is scarcity. Unlike traditional currencies, where governments print unlimited money, Bitcoin has a hard cap of 21 million coins. That rule is built directly into its code. No one can change it without the majority of the network agreeing, which is nearly impossible. This engineered scarcity mimics gold, but with a twist. Bitcoin is more portable, more divisible, and harder to counterfeit. Economists call this digital gold, and investors recognize it as the ultimate hedge against inflation. Scarcity wasn't luck. It was a deliberate feature to guarantee long-term value. Mining, incentives built into the system. Bitcoin mining isn't just about creating new coins. It's a carefully designed incentive system. Miners secure the network by validating transactions, and in return, they're rewarded with Bitcoin. This proof-of-work system aligns everyone's incentives. Miners want to earn coins, users want secure transactions, and the network becomes more robust as more miners join. Game theory plays a massive role here. Cheating the system costs more than following the rules. That's why Bitcoin has never been hacked. It's simply not worth the effort. This incentive structure was engineered to make Bitcoin self-sustaining. The halving cycle, predictable growth engine. Every 4 years, Bitcoin's mining rewards get cut in half. This event, known as the halving, slows down the rate at which new coins are created. Historically, halvings have triggered massive bull runs. Why? Because supply shrinks while demand keeps rising. This isn't luck or coincidence. It's an economic time bomb built into Bitcoin's DNA. Satoshi designed it this way to mimic scarcity over time, ensuring that Bitcoin becomes more valuable the longer it exists. Think about it. In traditional finance, central banks control interest rates and money supply. In Bitcoin, The rules are fixed. That predictability is a feature, not an accident. The community effect. Strength in numbers. Bitcoin isn't just code. It's a movement. From the very beginning, Satoshi attracted a community of developers, cryptographers, and financial rebels who believed in the mission. These early adopters weren't speculators chasing profits. They were idealists who saw Bitcoin as the foundation of a new financial system. As adoption grew, Bitcoin gained momentum. Businesses started accepting it, media covered it, and governments debated it. This network effect, more users making Bitcoin more valuable, wasn't luck. It was engineered into the system because Bitcoin works better the more people use it. Security by design. Bitcoin's security isn't just about cryptography. It's about the sheer scale of its network. Today, Bitcoin's proof-of-work mining consumes massive amounts of computational energy. Critics call it wasteful, but that energy use makes the system nearly impossible to attack. To hack Bitcoin, you'd need to control 51% of its mining power, something that would cost billions of dollars and likely destroy the very thing you're trying to steal. This security model wasn't accidental. It was engineered so that the cost of attacking the system is greater than the reward. Institutional adoption, the next stage of the plan. For years, Bitcoin was dismissed as a fad, but slowly it started winning over Wall Street. Companies like MicroStrategy, Tesla, and Square invested billions. In 2021, El Salvador even adopted Bitcoin as legal tender. And in 2024, the US finally approved spot Bitcoin ETFs, opening the floodgates for trillions of dollars in institutional money. These weren't accidents. They were the natural progression of Bitcoin's design. As scarcity increased, value rose. As value rose, institutions had no choice but to pay attention. The future. Bitcoin as the engineered revolution. So where does this all lead? Bitcoin wasn't created as a get-rich-quick scheme. It was designed as a long-term revolution in money. Every part of it, from decentralization to scarcity to game theory, was engineered for resilience. Today, Bitcoin is no longer just a currency. It's a store of value, a hedge against inflation, and a global financial network outside government control. The world is slowly realizing that this isn't luck. It's the result of a master plan laid out back in 2008. So when people say Bitcoin's rise was just luck, they're missing the point. From its launch during the financial crisis, to its fixed supply, to its unstoppable network effect, everything about Bitcoin was engineered to succeed. And here's the big question for you. If Bitcoin's rise wasn't luck, what does that mean for its future? Are we still at the beginning of this financial revolution? Thanks for watching. If you found this video eye-opening, make sure to hit like, subscribe, and share it with someone who still thinks Bitcoin is just a gamble. Because once you see the design behind it, you realize it's not luck at all. It's destiny written in code.